Good morning. It's Monday, September 22nd, 2025. I'm Herb Morgan, Senior Managing Director here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. You can find me intro week on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. Everything you're seeing and are hearing today is developed by me for use by you. Doesn't matter if you are an investment advisor or an individual investor. It's still for you, and you're expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice, no recommendation for the purchase or sale of any security. It's all for informational purposes only, and its accuracy cannot be guaranteed. The views are mine alone, do not necessarily represent and may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, the U.S. markets were higher last week as the Fed cut the Fed funds rate. Interesting, longer maturity bonds or longer dated, other than that very short Fed funds rate. Actually, rates went up. Bonds sold off a little bit as measured by the aggregate bond index and especially by the long dated Barclays 20 plus Treasury index. New York State Manufacturing and Philly Fed, two regional manufacturing surveys, which when taken together with some others, could give us an insight into the likely path of the national manufacturing survey. We start with New York State, or first month of September. We fell and went negative, minus 8.7. The estimate was for 5. New orders dropped considerably. Shipments dropped considerably. Employment fell. And the outlook fell as well. Not a great report from New York, but you can also see here that we can have a booming, growing economy and have a lot of negative reports. It could be more of a secular trend and is not necessarily indicative of the overall macro status of manufacturing in the United States. Moving on to Philly Fed survey, September Philly Fed Business Outlook survey. Did the exact opposite. It had a big spike higher. And Philadelphia and New York are very, very close to each other. So this just tells you you've got to take all data with a grain of salt. Went from a minus 0.3 to a 23.2, well above the estimate of 1.7. New orders here spiked. Shipments spiked. Employment was down, but not by much. And here the outlook went higher. Just the opposite of what we got from the New York State survey. So we put the two together, and there's nothing we can conclude from those two. We move on to retail sales in August, up 0.6%. That was triple the estimate of 0.2, the second straight month in a row, 5% above a year ago. Backing out autos and gas, still up 0.7 after rising 0.3 the last month. These are great numbers. It tells us that the consumer is strong and that the consumer is healthy. Import and export prices. Surprisingly, import prices gained 0.3. They're expected to actually go down. They remain unchanged on a year-over-year basis. Export prices gained 0.3 for the second straight month, and they're up 3.4% on a year-over basis. We move on to industrial production and capacity utilization. Notice here the capacity utilization graph. That's the red line here, kind of going down and to the right ever so slightly. In my mind, that represents disinflationary pressure. That's solid. We haven't seen it turn on core PCE price index yet or in CPI, but it is a good sign. August industrial production was up 0.1% after falling in July, and capacity utilization unchanged at 77.4. Business inventories rose 0.2%, second straight month, following no change in April or in May. Fine. Business inventories can tell different stories depending on how you interpret them. You look back at this chart and you can see, okay, business inventories declining as we shut down the economy, inventories booming as we gear up for the reopening of the economy. I get that. The rest of this, though, it's really hard to ever draw conclusions. When business inventories are climbing, it could mean demand is slowing at the other end, or it could simply mean that CEOs are confident of the upcoming selling season, and we're going to get into the holiday season. To me, this time around, it's more likely than not that it spells confidence in the upcoming selling season. National Association of Home Builders Sentiment Index continues to be really, really low, really, really bad, 32. The estimate was 33. That's unchanged month over month. Present sales at 34, that's pretty low. Future sales rose to 45, also low, and traffic just continues to be abysmal. Now, we did get a rate cut, and there has been some movement in mortgage rates leading up to that rate cut. There is actually starting to be a little movement on price. The problem is for new homes, there's not a lot of movement on price because the inputs to production, the cost of production, the cost of building really are impacted by inflationary pressures, so they're not going down anytime soon. The question becomes whether or not we get enough supply of existing product at some point to tip the scales and cause prices to go down. If that happens, that means it even delays further any recovery for new home product. Housing starts and permits remain not so good. Housing starts dropped 8.5%. The estimate was only for 4.4. Building permits fell 3.7% for the fifth straight monthly decline and the 10th monthly decline in the last 12. Not a good time to be a home builder. Now, big question a couple weeks ago when we saw the spike in initial claims for unemployment. Interesting. Reverses the large spike from the week before because the outsized gain in Texas, which we mentioned last week, now they're saying there was an attempted fraud. Somehow big movement of fraud in large scale to try to get benefits. They have apparently stopped that. And so we're right back down to this 230 level, which is very, very low, suggesting that the labor market is very, very strong. Interesting that we got that spike up right in advance of the Fed's meeting. If I was on the Federal Reserve Board, I would have certainly considered that spike up in unemployment claims before considering the rate cut because of the dual mandate that the Fed has: price stability, number one, and number two, co-equal, not in rank order, co-equal is full employment. We did get that Fed rate cut last week. You can see here, let's go a little recent history. Starting in March of 22, noticing that inflation was way above where it should be, the Fed began to hike interest rates, and hike they did, going all the way through to the middle of 23. So hike. Economy did pretty good. Inflation has come down, but not come down to target. Now, out of concern for a softening economy and a labor market, in attempt to preempt, and in the view that the inflation is on a path to its core 2%, it's a very risky move by the Federal Reserve as central bank, and probably because they're facing a large amount of political pressure from the administration to get rates down because the borrowing costs of the United States Treasury are primarily very, very short term, and this rate has a very significant impact, far more impact on the U.S. Treasury than it does on you and I. We peaked at 5.5% a year ago, and now we're seeing that number start to come down. We paused, and then we had another cut here last week. There was an awful lot of press, awful lot of discussion, awful lot of research, and an awful lot of hand-wringing over an event that really wasn't all that consequential. In fact, as I pointed out earlier, the bond market's actually sold off a little and interest rates went a little bit higher. Stock market just kind of brushed it off like it was a non-event, and that's really what it was. It was kind of a non-event. And when you back out of this chart and you look more from a historic basis, the Fed funds rate is kind of where it's been since 1971. This is the red line, represents the average Fed funds rate. Now, obviously, we did get to 20% in March of 1980. This was an attempt by Paul Volcker and the Federal Reserve at the time to break the back of inflation by jacking these rates up. And then we went in a slow but steady decline as inflation improved through to the 1990s. We then moved in past the dot-com bubble, and we then had numbers well below the long-term trend for a very, very long period of time. We had to go to zero for the global financial crisis. Just as we were getting back up, we went to zero again for the COVID crisis, and now here we are raising rates to try to combat this inflation. I submit to you that the inflation is more directly connected to excessive fiscal deficits than it is to this rate of interest. And I wish that the Federal Reserve members would be more vocal in challenging the members of Congress and the administration to do their part to relieve these inflationary pressures by addressing the structural deficits of the United States of America. And why? Because federal debt to GDP continues to grow I've been talking about this. There's a lot of discussion that says, hey, how can we grow the economy if we're at 128% GDP? Have we reached that tipping point like Japan, this sort of no growth for decades? And the answer is if we're relying on fiscal stimulus, deficit financed fiscal stimulus to continue to grow the economy, then yeah, we probably have reached that tipping point. But I decided to add to this graph household debt to GDP. Household debt to GDP, which had gotten close to 100% at the beginning of the global financial crisis, has come all the way down to 67%. In other words, the balance sheet of the federal government is quite horrible, and we shouldn't be depending on them for economic growth and stimulus at this point. But if you look at the One Big Beautiful Bill Act and you look at the trade negotiations and deals associated with trade negotiations for CapEx back into the United States, couple that with the fact that the U.S. consumer is very underlevered by historical standards, it suggests that we can perhaps pull off what they're trying to pull off, which is to outgrow the debt without adding any more debt at the federal level as a percentage of GDP, grow GDP through the private sector, get that number higher, bringing the overall federal debt to GDP level down. It will not be easy. It's a Herculean task. I like the plan. I hope we are successful. In terms of economic data this week, nothing today. Tomorrow, Tuesday, S&P Global's flash readings for September PMIs. You can see here 52.2. There we go. 52.2 for manufacturing, 54 for services. Those would be great. New home sales at 650, not so great. We get that right there. Weekly initial claims, 240. Second quarter GDP looking to be unchanged from the original print of 3.3. Durable goods, home sales, personal income spending, and the all-important PCE price index. 0.3% is the number. If we could get something less than that, 0.2, 0.10, it would be fantastic news for the equity markets. But the consensus is now that it will be 0.3%. This is available on many audio podcast formats. It's only available in one place with the charts and graphs and my beautiful face. That is the YouTube. Slaying Bulls and Bears is the name of this presentation. I aim to make the complex and complicated simple and sensible, and I bring this to you every Monday. Thank you for tuning in.